Hi guys, good afternoon and welcome to the CNBC TV18 Mumbai News Center. I'm Pavitra Parekh. With me is Sonal Bhutra and you are tuned into Mutual Fund Corner. Today we're excited, we're talking about a very exciting topic which is all about balanced advantage funds. And before we take you through the data and also invite our guests, let me actually toss it over to Sonal. So Sonal, why don't you take us through what balanced advantage funds really are?
Well, Pavitra, as we've been discussing, they have been a very interesting fund that a lot of these industry experts have been talking about. They are also known as dynamic asset allocation funds, and they are from the category of hybrid mutual fund schemes. They invest in the asset classes both, the likes of equity and debt as well, and they keep modifying these asset allocations basis the market conditions. So, of course, there's equity, there's debt. In terms of equities, they invest in stocks and other equity instruments, and on this, investors get the market-linked return. So that's the equity component. On the debt component, it is investment in debt securities, as the name suggests, and they get a fixed rate of return on this, and this is basically to protect the investors from the volatility that we continue to see in the markets as well. And as I mentioned, schemes, they keep adjusting their equity and debt contribution in this particular fund in order to level it as per the market conditions. We'll discuss this more with our expert as well. But Pavitra, we've been talking about flows specifically for this particular flow, for this particular fund. What have the flows been like?
It's actually very interesting. So let me run you through that. In fact, all of last year, that is all through 2021, we were talking about balanced advantage funds being this rising category and only growing in popularity over the months. So, the figures will come up for you, and it fit quite well, right, at a time of high market volatility where you could really rely on a fund manager to alter the equity and debt split depending on whatever the shifting market conditions were. In fact, in 2021, the assets under management came in at over 71,000 crores. That's the figure over here on your screen. And this is actually the highest growth that we've seen among all equity and hybrid funds. So that is the kind of popularity that these funds were seeing. But now for several months, if you see, the net inflows into this category, that is into balanced advantage funds, have actually been coming down. So for the past 2 months, if you can see, that is for September and October, there's actually been an outflow. September, it does look like an inflow over here, but if you remove the NFO amount from this, there's actually been an outflow in September, and then in October as well, we did see an outflow, and this figure is at around 453 crores. That is for the month of October. Now, just to take you through what the equity to debt split is like in some of the more popular funds, I've gone through only the top 5 so that I could, present that data to you. But if you take a look at that, and these are the top 5 funds by AUM, so the split is mostly around 67 to 70% in equity and between 16 to 24% in debt. So this is for the top 5 funds by size. If you want to zoom out a little bit, you can see that actually the highest exposure to debt across all balance funds is around 32%. That is the highest. And if you want to take a look at the lowest one, it's around 4.4%. So, to help analyze all of this data that we have and to also take us through the case for investing into this category, we're joined by our guest on the show. Prableen Bajpai is founder at FinFix. So, Prableen, thanks a lot for joining us. This is Pavitra. I also have Sonal with me on the show. And, if you heard all of that data, my first question to you is, why is this happening? This was such a popular category that we saw all through last year. So why has why have the inflows been coming down so much? And is this a trend that you expect will keep playing out going forward?
Good afternoon, Pavitra, and good afternoon, Sonal. To answer your question, Pavitra, I think the relevance of balanced advantage funds as a category tends to increase in certain specific market styles, the markets that we've seen in the past 2 years. And it's not only the relevance, the narrative around these funds also went up. And let's just go back to the year 2020 when COVID began. In March of 2020, we saw a huge dip, and Nifty year to date at that time was down by about 35%. And that was the time, I think, when investors started to become unsure what the future was like. But very quickly, the markets recovered, and some investors were able to participate in the rally, and remaining was sort of waiting on the sidelines for further corrections to happen in the markets, which did. And I think the trend started to begin from there. And 2021, we again saw something similar happen. A lot of investors, I think, were now left with questions like, will this rally continue? When do we enter? What do we do now? Because we've missed the COVID rally. And I think that is where the relevance of this category became very prominent. And investors started to put in their money in this particular category because, as a structure, it sort of works on the principle that you buy low and sell high. So instead of waiting on the sidelines for the markets to correct, probably this seemed like a more viable option, that you invest in the balanced advantage category funds and they will do the asset allocation for you. They will invest in the markets when there is a dip. And I think 2022, when it began again, the markets were fine, but then we saw Fed come into action. We saw Russia and Ukraine, and there were still jitters. But what happens is, because these funds, by the very structure, were themselves were not able to participate much in the rally that we've seen in the past, let's say this year to date. I think now the investor confidence has begun to rise that, okay, markets are doing fine. Maybe we don't really need to sit in the balanced advantage category and we can participate in the markets on our own. And I think that is the reason why there is some bit of exit. So I think the guard is down from an investor's point of view, and the category has not been able to deliver returns because theoretically it can, but it still needs some time for it to perform. So I think there is some bit of disappointment and a little rise in the confidence at investor level.
All right, maybe people are more comfortable then moving to, more of an equity play. But Prableen, just to take this point further, most of the top funds that I was just highlighting as well, they have only around 20% in debt, right? Just at an average, some of the larger funds have 20% in debt. What could be the, the reason for really opting out of these? Because it's not like the debt exposure is so high. In fact, within this category, you can go as low as 5% for debt as well. And on that ground, if someone is looking at getting into a balanced advantage funds, they are quite optimistic on equities. Do you think it makes sense to make that a key factor when you pick a balanced advantage funds? Maybe pick one with lower debt?
Right. So, Pavitra, the figures that actually you have shown are gross equity figures, but that also includes the hedged portion within equities. And if we look at the unhedged portion, which is your core equity, which these funds are holding, there are funds like ICICI Balanced Advantage, which are holding as low as 31% in pure equities, which is the unhedged position without arbitrage. Funds like DSP are holding around 40% in core equity. So that has been, one of the reasons why these funds have not been able to, sort of deliver returns which are in line with the market. And they haven't really got a chance to further increase the percentage allocations to equity. So the debt allocation as a category is usually kept by all the funds anywhere between, let's say, 5% to 35%. And equity, which is a combination of hedged and unhedged positions, is kept at 65. So when somebody is looking to invest, I think what is important is to check the core equity exposure that that fund has. And then you know that, okay, this is the current participation by these funds in the equity markets. And if there is a correction in the markets, they have a buffer of, let's say, 60% in case of DSP, they have a buffer of 70% in case of ICICI. That money can actually move into equities. And all of these different schemes, within the category have their own in-house models, which governs this percentage, what will be kept, what percentage in which asset class.
Okay, interesting take there, Prableen. There is one more component that we talk about in these balanced advantage funds, and that is the arbitrage component. How do returns work here? Because there could be unhedged, hedged. How do things look in this case?
So the arbitrage component, Sonal, is actually used by these funds to maintain their equity positions at 65, so that they, in terms of taxation, they remain viable. And arbitrage, if we see as a category in itself, if we look at arbitrage funds, the returns, they have been slightly disappointing. The past 6-month returns for arbitrage as a category are barely 2%. And for the last 1 year also, they are about 3 to 4%. So arbitrage is able to reduce the risk that these funds they are exposed to, because they are hedged positions. But the returns that that component has been able to generate for these funds has been very low. And that, along with, about 30, 35% or 20% in debt. So majority of the funds which are actually working on this dynamic, play between equity and debt have also, for the lack of a better word, let's say, missed the rally and are currently in a position where they themselves are holding a lot of cash or investable amount in arbitrage and debt, actually.
All right, got that. Prableen, very useful, but we have to get into a short break here. So I request you to please stay on. We're going to come back in just 2 minutes and we have lots more questions lined up on the other side.
Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV18, and today it's all about balanced advantage funds, and we have with us Prableen Bajpai. Prableen, we have been talking about what's happening as far as the flows in this particular category is concerned, but after returns, what investors also look at is taxation. So tell us, how are these funds taxed, considering that the exposure is both towards equity and debt? What category is it considered as?
This is the good part for investors because they're taxed as equity. They are able to maintain the 65% by using arbitrage strategies, and that makes them very tax friendly because if they're redeeming within a year, which they shouldn't be doing because it's an equity exposed scheme, but they'll still be taxed at 15%. And if the fund is there kept, they are invested for more than a year, then Sonal typical equity taxation, where for profits up to 1 lakh, there is no tax, and 10% beyond that.
All right, that is on taxation of these funds. Prableen, you know, we were talking about how perhaps investors are moving away from this category to more pure play equity kind of funds. But take us through, when do you think is a good time for an investor to look at a balanced advantage funds, and what do you see as the key benefits of this category?
Right. So I think, Pavitra, for an investor, if I have to give an example, somebody, let's say, who's looking to park 10 lakhs today and is unsure again about that the markets are at all-time high, it becomes a decent option for them to, park their money, because the fund itself will rebalance and move from debt and arbitrage into pure equities. And this is where you need to know the component of how much is there in debt, how much in arbitrage, and what is there in your pure equity. So if a fund is, let's say, sitting on 31 or 35 or 38% in equities, so you know that if there is a further correction, there is a huge scope for the fund to park money into the equity markets. So I think that's one thing, there is a rebalancing between the two asset classes. The second, I think, factor for which investors can invest is to reduce their downside risk. So there are investors who want to participate in equity markets, but do not want to undertake the risk which a pure equity fund brings. And many of these funds from the balanced advantage category were able to contain the fall even during 2020. So 1 year returns for 2020, certain funds like DSP, Axis, and Edelweiss, they restricted the lows to about -8 to 9%, which was pretty good as compared to 31-35% fall for pure equity funds. The third thing I think very important is the behavioral management. We say that, yes, we should invest in markets when there is bloodbath and, markets are in red, and we should follow valuations and fundamentals, but we all don't do that. So I think the behavioral aspect of investing is taken care of by these funds. Having said that, because they work on certain parameters and certain conditions need to be met, there will be times when these funds can also underperform, like the current times. So, but the behavioral part is well managed by them. And the fourth and very relevant one is for a systematic withdrawal, because they bring in equity taxation. They have better risk-adjusted returns. If you look at the past 10-year, 15-year returns for this category, it is somewhere between 10 to 14%. So I think that becomes a good option, and a SWP at about 5 to 6% can help investors get some money on a monthly basis, and yet ensure that the fund is growing and their funds are growing.
Okay, so those are the advantage of balanced advantage funds, that is. But Prableen, in case you have to talk about the don'ts or about investors who should not be looking at these funds, what would you recommend? What is a category of investors who should not be investing in such funds?
Sonal, first of all, I think equities, it can really ask for your patience many a times. Even pure equity funds, SIPs, for 3 years sometimes don't show returns. And I think balanced advantage category can take your patience test to the maximum level, because they all work on a certain mechanics principle, and that may work in a certain market conditions. The triggers which they have for ensuring the exit and entry into equity markets may not work in specific conditions. So investors have to be patient. So if somebody is there who is looking at, the rally in their, a quick sort of a return in their funds, I think as it is, this is definitely not the category for them. Second, this is not a risk-free category. It is often pitched as, that low risk and less risk. There will always be risk because there is an element of equity. And with an element of equity, risk can never be totally negated. So again, it can never be substituted, or somebody who's looking at a risk-free investment should never invest in these funds. Over a long time period, they're able to, of course, reduce the amount of risk they have. That all equity investments are able to. Thirdly, I think very important is that investors tend to think that, okay, I'm investing in this fund, so maybe my asset allocation is now taken care of. And that, Sonal, can happen if all my money is invested into one scheme and, that's all about it that I have. Because then only your asset allocation can be managed. Otherwise, your asset allocation cannot be left to a scheme. So at scheme level, you cannot just park your money and think that your asset allocation is taken care of. So, these are broadly people, things that they shouldn't be doing, and investors who shouldn't be investing.
Okay, all right, Prableen. So those are certain important aspects that everyone has to take care of course, while investing in such funds. Quickly, if you can tell us some of the balanced advantage funds that you think could benefit investors. We are short of time, so we would request you to keep that answer a little short.
Okay. So, HDFC has been a great performer, but I'll not call it a pure balanced advantage because it works more like a hybrid. So other than that, I would say Edelweiss, ICICI, Kotak, DSP, I think these are some of the funds investors can look at. They'll have to have the patience and give the funds the time to perform.
All right, Prableen, we're going to leave it on that note, but thank you very much for taking us through that complete explainer on what, this category really is, the key advantages and disadvantages, and also breaking down the data for us. Very useful for our investors. We're going to wind down on that note, but remember, you can always email us all of your mutual fund related queries, and we will also take them up with our experts. You can stay tuned. Closing bell will come up next, and it is going to take you through the last hour of trade.